What's up, guys? Welcome back to the channel. This is Timmy Solomon Wisdom, and in today's lesson, I'll be covering liquidity concepts. By the end of today's lesson, you will have a comprehensive understanding of liquidity concepts and how to use this liquidity concept to identify high probability trade opportunities in the financial markets. As a follow-up to last weekend's lesson, where I talked about entry models, I gave you updates on entry models. But today, I'll be diving into the world of liquidity as requested by some of our students. So let's get started. These are what we'll be covering in today's lesson. You're going to understand what is liquidity. We cover buy-side and sell-side liquidity, understanding internal and external range liquidity. You know what liquidity grab and liquidity sweep means. You understand what liquidity run means, and you equally understand draw on liquidity. And I think the most important concept to be covering today is draw on liquidity. So stay connected with us as we study all these liquidity concepts and equally understanding draw on liquidity, which is the next liquidity point price is likely going to target or draw to. So these are all we'll be covering today, and we'll be taking them step by step. So if you are new to the channel, consider subscribing to the channel. I'm Solomon Wisdom, and here is Born to Trade. So let's jump straight into what we have for today. Now, the question is, what is liquidity? For me, liquidity is what moves the market. Every movement you see in the market is fueled by liquidity. The market survival depends on liquidity. In simple terms, I can say that liquidity is the market's oxygen, sustained by the flow of traders' money through stop losses, buy stops, sell stops, take profits, even buy limits and sell limits. So this simply means the sell stops, the buy stops, the take profits, and all that, buy limits and sell limits. These are liquidity. These are money. Liquidity is simply money, areas in the market where we have money resting. And one thing you have to understand is that why money rests in these markets, there are areas where money rests the most. We call that liquidity pool. Where money rests the most is what we call liquidity pool. So I'm going to talk about the key liquidity areas. Key liquidity areas is going to help you know the areas in the market where money rests the most, okay? So let's cover that. We're going to start with buy-side liquidity. Now, buy-side liquidity is the accumulation of liquidity above current highs. It's comprised with stop loss of traders with short position. So this is simply having areas where we have stop loss at the buy side, okay? Now, let me go again. Buy side liquidity is accumulation of liquidity above current highs in the markets, okay? Now, where is the current high in this particular market? If you look right here, this is the current high we can clearly identify. As a matter of fact, we have a lot of highs here. We have this high, and we equally have this particular high. Now, one thing you have to notice that liquidity rests above this particular high, but where is the most current high? The current high we have is this particular one we have over here. So having this particular high over here means that this is the most current high and liquidity rests above this particular high. And how is liquidity resting above this particular high? Now, stop loss from traders with short position. So any traders that are shorting this particular market is likely going to have their stop loss above this particular high. Why? This particular high we have over here is a swing point. So most traders usually place their stop loss above the swing points in the market, which is this particular high. This is actually a swing high. Now, other type of traders who could place their orders around this particular area are breakout traders. Now, breakout orders from traders anticipating upward price movement. So any trader is expecting that price is going to break out of this level and continues upwards. So they're going to have their stop loss above this particular high. So this simply means that money rests above this particular high and there is a lot of liquidity above this particular high. Now, these liquidity pools create potential reversal points as they provide a concentrated source of liquidity that institutional traders can tap into to execute sell orders. Okay, now once there is liquidity above this particular high, now we know that a lot of orders are placed above this high, which means that we have a liquidity pool, which makes it a key liquidity area. Now, the institutions going to see here as their reference point. They either come here, takes the liquidity and push price lower. That is placing large sell orders, which is going to push price lower. Okay, I hope this makes sense to you. Now we have another one which we call the sell side liquidity. Now the sell side liquidity is the opposite of the buy side liquidity. Sell side liquidity refers to the accumulation of liquidity below current market lows. It consists of stop losses from traders with long positions. Now, where do we have sell side liquidity? This is the low right here. Just like I said, it refers to the accumulation of liquidity below current market low. So where is your current market low? This is your current market low. So liquidity rests above your previous high and previous low. So this is actually the previous low in this particular case, and liquidity rests below here. Now, how do liquidity rest under this low? Stop loss from traders with long position. So any trader that is going long from this particular area has his or her stop loss underneath this particular low. So since a lot of traders have their stop loss right here, this is a key liquidity area and liquidity rest here. Now, what other type of liquidity is going to be resting underneath this low? We have breakout traders. Now, breakout orders from traders anticipating downward price action. So any trader that is anticipating that price is actually going to break out of this low and continues lower has an order right here, probably an order which is going to tag him or her into the trade once price starts to drop lower. So this is another form of liquidity. So liquidity rests above highs and lows in the market. As a matter of fact, if I want to take this further, you can agree with me that we have liquidity resting above this high. Yeah, liquidity still rests above this high. This is actually an internal structure. Liquidity rests here, and this low right here, liquidity rests here. So the truth is that liquidity rests above highs and lows in the market, but we're actually paying attention to key liquidity areas. So paying attention to key liquidity areas, this high right here is our key buy side liquidity, and the low we have right here is our key sell side liquidity. Okay, I hope this makes sense to you. Now, for the sell side liquidity, these liquidity pools create potential reversal points as they provide a concentrated source of liquidity that institutional traders can tap into to execute their large buy orders. So if the institutions decide to drop pushing price lower right here, they're going to tap into this liquidity pool and probably push price to the opposite direction. So if you understand liquidity concepts, this is going to be very easy and it's going to make sense to you. Now, we have other forms of liquidity where we have equal highs and equal lows. I've already explained those type of liquidity, and that's not actually what I'll be covering in today's lesson, because these are the easy liquidity areas which you all know, where we have equal highs and equal lows. We have trend line liquidity. These are the type of liquidity that is actually very obvious. So let's look at another concept right here. We have what we call external and internal range liquidity. External range liquidity refers to the price range extremes where the highs and the lows act as liquidity pool. So this is exactly the same thing I explained about buy side and sell side liquidity. For external range liquidity, this is where liquidity rests above the high and it rests underneath the low. So let me go again with the definition. External range liquidity refers to the price range extreme. So this is actually an extreme price. This is a price range extreme, and the one we have down here is a price range extreme. At this particular high and lows, these high and lows act as liquidity pools because liquidity is resting above the high. Then why is it called an external range liquidity? It's called an external range liquidity because liquidity is resting outside this particular range and outside the range, right? To break this down further, this simply means that any liquidity you see resting outside this particular price range, that's your external range liquidity, and anything resting outside this particular low, this range you have over here, this is what we call your sell side liquidity. So in order to put it in a better context, you can just say that the ones we have above this high is your buy side external range liquidity, and the one we have underneath the low is what we call your sell side external range liquidity. I hope this makes sense to you. So we equally have what we call internal range liquidity. So what is internal range liquidity? Now, internal range liquidity, these are areas between the price range high and lows. Okay, so everything inside this price range is what we call your internal range liquidity. That's why I said these are areas between the price range highs and lows. So anything inside this particular range is called your internal range liquidity, while everything we have outside the range is what we call external range liquidity. So anything outside the range, external, anything inside the range is what we call internal range liquidity. So I hope this is actually making sense to you. To explain this further so you understand, institutional traders leave footprints in form of order blocks and price inefficiency inside the range. Now, inside the range, the type of liquidity we have inside this price range is usually your order blocks and price inefficiency. So the institutions usually leave these footprints inside the price range. So these are the liquidity areas we have, right? You have your external and internal range liquidity. And what is the examples of an external range liquidity? A perfect example of an external range liquidity, the liquidity resting above your highs and underneath your lows is an example of your external range liquidity. And the perfect example for your internal range liquidity is your order blocks and your fair value gap. So just like what we can clearly see from here, I can identify that we have a fair value gap. So this fair value gap we have right here is an example of an internal range liquidity. And if I look underneath this low, I think I can easily spot maybe a lower time frame order block around here, which serves as your internal range liquidity. Okay, so I hope this makes sense to you. Let's continue, and I believe before the end of today's lesson, you will understand exactly where I'm driving at. Another thing traders struggle to understand is what we call a liquidity sweep. And sometimes people call it a liquidity grab. Now, what is a liquidity sweep? A liquidity sweep is a price movement that breaks a previous high or low, only to reverse direction and move back into the opposite direction. Now, liquidity sweep is simply when price moves above an old high or underneath an old lows and immediately reverses to the opposite direction. So let's press price forward and see example of liquidity sweep. Okay, let's see what liquidity sweep means. So playing price forward right now. So at this particular area, you see price moving above this particular high. So price moving above this particular high, then let's see, and moving immediately back inside this particular range. This is the sweep of this particular high, and this is simply price sweeping the buy side liquidity. I hope you can see that price immediately moves to the high, sweeps the liquidity, that is taking the liquidity and moving back into the range. This is what we call a liquidity sweep. Now let's see, and this is exactly what you see in here. Price moves underneath this low and moves back inside this range. Now continues inside the particular range. So this is what we call a liquidity sweep. Now we can go ahead and say that we have the liquidity sweep of this particular high, and we can equally say that we have the liquidity sweep of this particular low. Now let's talk about liquidity run. What is liquidity run? Now, for a liquidity run, a price movement where the market breaks out above an old high or below an old low and then continues to trend in that direction. This indicates a successful liquidity run. So we're going to look out for a liquidity run in this particular case. Let's use this scenario to try identify what we mean by a liquidity run. Now, in this particular case, if you want to identify your price range, we have a lot of price range right here. If you try to identify your liquidity points, this is your buy side liquidity over here, and underneath this low is your sell side liquidity. And if you try to look at the internal structure, you can as well see this is actually another low right here. Okay, this is the current high and this is the most recent low. But another thing you can identify from here is that we still have an external range liquidity around this area. But let's focus on this particular one. Now let's try to play price forward to see. Now, in this particular case, what can we see? Price react to the upside and runs the liquidity we have underneath this low. So price running underneath the low without pulling back to continue inside the range. This is what we call a clear liquidity run. Okay. Now, I hope you get the difference between a liquidity run and a liquidity sweep. Now, let's come over to the concept of draw on liquidity. So draw on liquidity, sometimes I call it liquidity magnet. Now, why do I call it liquidity magnet? This is identifying the next liquidity point that is likely to attract price, okay? This is simply the next liquidity point price is likely going to move to. If you understand the next liquidity point price is likely going to draw to, this will help you frame a lot of trading ideas. As for liquidity concept, you use liquidity concept to frame a lot of trading ideas, and I've also explained some of them on this channel where I taught you guys how to trade the turtle soup pattern. I taught you guys how to trade the liquidity sweep pattern. I taught you guys how to use liquidity as high probability trade patterns where you spot liquidity areas as confluence above your POIs, where price sweeps this liquidity and mitigate your point of interest. I've explained a lot of patterns. I've also explained the Asian highs and the Asian lows type of liquidity. Okay, but let's go ahead and do some examples, which is going to help you understand some of these liquidity patterns and how you can use some of them to your advantage. Okay, so let's go ahead and do some of these examples. Now, for this particular area, where is your price range? Where is your high and where is your low? And this is very, very simple to identify in this case. Where is your current price range? This is your current high. And where is your low? This particular low right here is an old low, okay? Now, one thing you have to understand is that if price sweeps the liquidity and moves back inside this range, this is what we call a clear liquidity sweep. But if price moves above the high and continues higher, this is what we call a clear liquidity run. And believe me, if price takes this high and move back into this range, this is what we call a turtle soup pattern, because turtle soup pattern is simply price moving above an old high or moving an underneath an old low, then moving to the opposite direction. So let's press price forward and see. Now, you see, price moves above this high and moves back inside this range. This is a liquidity sweep. Now, someone is going to ask, how can we get involved trading this liquidity sweep pattern? Let's assume you want to trade this turtle soup pattern. How can you get involved? Now, let me take price back. So at this particular point, you see price sweeping the liquidity above this particular high. The first thing you want to do if you want to get involved is dropping to the lower time frame. So let's use the 30 minutes time frame. Currently, we're on the 2 hours time frame. So let's drop to the 30 minutes. So here is the 30 minutes time frame, and you can see price already swept the liquidity we have above this particular high, and we have more liquidity resting underneath this low. Now, how can you get involved? The truth is that we have a lot of entry models. I've also explained a lot of entry models, but the entry model we're going to use in this particular case is the mitigation of a fair value gap after price shows clear bearish intention. So let's press price forward right now and see. Now price starts to drop, okay? So now that price is dropping to the downside, what are you going to do to get involved in this particular trade opportunity? What you have to do is to try to identify where we have the fair value gap. Now, if you try to remember the concepts I was teaching, you're actually going to understand that price swept towards the buy side liquidity, which is your external range liquidity. And I said everything inside this price range is what we call what? Your internal range liquidity. So let's mark the current external range liquidity. This is actually your current high right here, which is your external range liquidity. And where is your current internal range liquidity? Your current internal range liquidity, which is actually very obvious right here, is this fair value gap we have right here. And I said your internal range liquidity is your fair value gaps and your order block. So to get involved in this particular trade, all you have to do is to wait for price to come back to rebalance this inefficiency. And this is your nearest draw on liquidity. This is your nearest liquidity point price is likely going to draw to. So playing price hold right now, then you see price comes back, rebalances this inefficiency, and we have some reaction to the downside. Now playing price forward, you see price continues to drop. And if you try to zoom in right now, what can you see? You see price coming back to rebalance another inefficiency right here. And you see this failed the continuation of the reaction to the downside. So understanding your internal range liquidity and external range liquidity is going to help you identify some key reversal points price is actually going to move to. Okay, now playing price forward to see what price is likely going to do again. Now you see price reacting to the upside massively and dropping again. Now, if you want to pay close attention to what price was actually doing at this particular area, what can you see? Price reacted to the upside again to do what? To take this buy side liquidity we have over here. You see price react massively to the upside, sweeps the liquidity we have above this high, and we have the massive reaction to the downside. Now, this is price leaving another fair value gap right here. Now, leaving this fair value gap again, where can you get involved in this particular trade opportunity? we can get involved if price comes back to rebalance this inefficiency we have over here. Now playing price forward, you see price taps into the fair value gaps and drops again. Now that price drops to the downside, what can we see? We have another liquidity sweep of this old low right here. This was actually the previous low, and if you try to zoom out, you see it was this particular low that printed this high that was swept. The price has now come back to sweep this particular low. And you can agree with me that we could have some pullbacks right now. Why are we going to notice some pullbacks? You're going to notice some pullbacks because price swept an old low. Now, this is one thing you have to understand. If you want to really study liquidity concepts and understand it, you need to forget about market structure, because if you're actually looking at this from market structure point of view, you're going to get confused and you might not really understand what price is actually doing. From what I can actually see, we have a key level of supply right here because price moved and it broke structure right here. So it's possible that price could come to mitigate the order block we have right now. Now in my book, this is not a valid order block, but is it another block? Yes, it's another block. So this is another block right here, and it's possible that price is going to come back just to rebalance this internal range liquidity, because your external range liquidity is your buy side and sell side liquidity, and your internal range liquidity are your fair value gaps and your order block. Price has been rebalancing fair value gaps right here, and over here we have an order block. So let's press price hold to see if it could rebalance this order block. Now you see price comes back, taps into your order block nicely and starts to drop lower, and over here you see price rebalancing this inefficiency we have over here, and we have the continuation to the downside. So I hope this makes sense to you and you're actually understanding exactly what I'm explaining. Now, one thing you have to notice right now is that this is actually your new buy side liquidity. Liquidity is resting at this external range. Okay, so I can actually pick this and place it at this particular high. Maybe let's go to the 2 hours time frame. So here is the 2 hours time frame, and you can see this is your current liquidity high, right? This was actually the previous one that was swept, which was able to push price lower, and you see price rebalancing some internal range liquidity, playing price forward. You see now that price is pulling back, this is your new sell side liquidity over here. This is very obvious. Now, see price moves above the high again, sweeps the liquidity. Now, if you want to get involved once more, you do the same process, drop into the lower time frame. So just like I said, price could offer different entry models, but let's just stick to entering from the lower time frame fair value gap. Now this price sweeping the liquidity, moving back into the range, and there is no clear fair value gap currently. So let's see. Okay, price starts to accumulate at this particular area. You see price accumulates orders right here. So this accumulation, maybe I didn't talk about it, but this is another form of liquidity. Now liquidity rests above the high and underneath the low, but what you see is that price sweeps this liquidity above this high. Liquidity sweep at this area. Now let's see. Price reacts massively to the downside. Now, where do you have the fair value gap which you could possibly get involved from? This is the fair value gap, and you see price already tapped into this fair value gap. So it's possible that price could continue lower just to target the sell side liquidity we have right here. Okay, but I'm actually going to drop some lessons in the description talking about the liquidity sweep pattern and even draw on liquidity. So these lessons is going to help you understand these key liquidity areas and take good advantage of these areas. So let's press price forward. See, price starts to move away. Okay, price starts into the fair value gap, and here is the reaction to the downside. So this is actually a very good one, and if you really want to study this concept, it's going to help you. And this is exactly the same pattern we have right here. You see price moves again, moves above the new high. You see this was actually the old high that was swept before the reversal. Now here is the new high. This is the new high, and this reaction to the upside swept the new high and it dropped. Now questions is going to come in, and someone is going to ask me, how do we know the next external range liquidity that is going to be targeted? How do we know if price is going to target the buy side or the sell side liquidity? Now, it's actually very simple. If price is bullish, price is likely going to target the buy side liquidity. And if price is bearish, price is likely going to target the sell side liquidity. How do I know this? I know this because if you know liquidity concepts, when price is bullish, your lows are protected. And when price is bearish, your highs are protected. So price takes the liquidity and we have a drop right here. So where is your current liquidity high? And this is the low right here. Now price sweeps the high and drops. So this is your current liquidity high right here. Now, one thing you have to note if I try to zoom in is that we still have an internal range liquidity, just like I said. Everything inside the range is your internal range liquidity. And over here, I can spot a very good fair value gap right here. So if you play price fall, it's possible that price is going to mitigate this, but let's see. See, price rebalances the fair value gap and we have a drop, okay? Not just rebalancing that, you see price coming over here again to build an accumulation. Accumulation is another form of liquidity. After the accumulation, price sweeps the liquidity above the high, doing what again? Rebalancing this next fair value gap, which is the pricing efficiency, and it drops again. So I hope this makes sense to you. And just like I said, I'm going to drop the lessons in the description about liquidity concepts, which is going to help you understand draw liquidity, liquidity sweep, and how to use them. This lesson is actually going to help you. I'm actually going to drop the lesson on the turtle soup pattern, which are liquidity-based concepts, which is going to give you edge in the financial market. So I hope this makes sense to you. Thanks very much for watching this. See you in the next lesson.